We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to the Long-Term Investor. This is the third and final episode in the Hire an Advisor series. In episode 24, I shared some simple context to the initial part of the decision to manage money yourself or hire a professional to help. In that episode, I go through some of the typical motivators for both managing finances yourself and hiring a professional, but also summarize a highly cited Vanguard research study on the quantitative value of a financial advisor. In episode 26, I highlighted the differences in types of advisors. So in that episode, you learned about different advisor titles and professional designations people list in their email signatures or on their business cards. But I also explained the trickier things, like differences in compensation, both at the firm level and at the individual advisor level, and perhaps most importantly, the differences in standard of care the professionals are held to. You can find these episodes as well as a full archive of all past episodes by visiting thelongterminvestor.com. And please be sure to subscribe on whatever mobile app you use for podcasts to make accessing old and new episodes even easier. With those first two episodes focused on understanding some of the basic differences among financial professionals, this episode will focus on the process of hiring the right person for you. Fortunately, the internet has all of the meaningful information needed to narrow down your choices to 2 or 3 prospective advisors. But here's how you start your search. First, make a list of firms or people you know that you would consider hiring. You may not know if people on your list act as a fiduciary at all times or carry one of the 3 designations I described in the earlier episodes, CFP, CPA, or CFA. And that's okay for now. Feel free to ask family, friends, professional colleagues, or another trusted source to expand your list of advisor prospects. If you aren't comfortable asking others for referrals, then maybe visit something like letsmakeaplan.org, which allows you to search CFP professionals by city, state, or zip code. And from there, you can even narrow the search by portfolio size, type of advice, language capabilities, and advisor compensation. Step 2 is to visit brokercheck.finra.org to check each prospective advisor's record for misconduct. If the prospective advisor is a registered investment advisor who's bound by the fiduciary standard, you'll be redirected on that site to the Securities and Exchange Commission, or the SEC's website, where all the records of disputes, if any, are going to be listed. And if there's record of misconduct, I'd personally consider removing that advisor from your prospect list. These websites also list any credentials the prospective advisor has earned, such as the CFA, the CFP, the CPA. And anyone without at least one of these designations, I personally feel like should be crossed off your list as well. The third step is to visit the prospective advisor's websites. While this is a bit like judging a book by its cover, a website contains valuable information about a person's background and capabilities. You might even consider viewing the firm's blog to see if they have any content that's relevant to you. And not every article needs to be tailored directly to your needs, but a firm that hasn't written about the things that are important to someone in your stage of life probably doesn't have a lot of experience providing advice to someone like you. You can also check out a prospective advisor's LinkedIn profile for additional information. The fourth step is to narrow down your list of finalists. Send 2 or 3 advisors an email requesting a discovery meeting, and they will undoubtedly have lots of questions for you. But your questions are going to be more important at this stage. Equally important is how you ask those questions. People tend to ask prospective advisors different questions, which can make comparisons tricky. And you also have to contend with the human brain. Specifically, our memories are worse than we realize, and our decision-making is often biased by unimportant factors. The way to combat these issues is to hold a structured interview. The structured interview process was made popular by Nobel Prize-winning psychologist Daniel Kahneman to help reduce the impact of bias on our decision-making. However, the first time I saw it applied to hiring a financial advisor was in a column by Jason Zweig of the Wall Street Journal. I'm going to walk through a list of questions for a structured interview, along with some commentary to help you identify responses that are generally in your best interest. And I've also included some follow-up questions you might want to ask. If you add one of these follow-up questions to your list, then just make sure to give the other prospective advisors an opportunity to answer those questions as well. For your convenience, you can download a structured interview worksheet from peterlazaroff.com/worksheets, or of course in the show notes at thelongterminvestor.com. So here we go. The first question: how do you get paid? Ideally, an advisor is paid by the client and only by the client. If the firm is receiving revenue from any other sources, then there's opportunity for conflict of interest. Question 2: does your firm earn revenue from anyone other than me? Pretty similar to the first question with a little nuance, and the answer you want to hear is no. Fee-only firms that generate revenue directly from the clients and only the clients are going to have the fewest potential conflicts of interest. Now, some good follow-up questions, depending on the response you get, might be, do you earn any fees for referring clients to specialists like estate attorneys or insurance agents? Or do you participate in sales contests or award programs, creating incentives to favor particular vendors? Third question: what services do you provide? And would you consider charging a retainer or charging by the hour instead of a percentage fee based on my assets? Advisors who won't consider a financial planning fee are probably more focused on investment advice. They likely consider financial planning advice as an afterthought, meaning it will be far from comprehensive, in my opinion. To be clear, there's nothing wrong with charging a percentage fee on the assets being managed. In fact, I think that if you don't do that, you're not going to get the behavioral coaching and the asset allocation advice and the rebalancing and tax loss harvesting and all the things that will lead more likely to a better outcome if you aren't paying for investment advice. But the question of understanding whether or not you could just pay for financial planning really will show whether or not someone emphasizes the financial planning process or not. Now, if you do end up considering hiring somebody by the hour, there's a few things I think you ought to keep in mind. Now, I'm of the opinion that hiring an advisor by the hour is better than nothing. But if you're going to pay for financial planning exclusively, I personally feel like hiring an advisor on a flat retainer fee will make it more likely that they reach out to you proactively with money moves they're going to help you at important times. Because I've seen people who hire an hourly advisor who occasionally put off calling or emailing the advisor because they don't want to pay for the advice. So instead of getting that professional advice they've worked so hard to find, they rely on themselves and maybe some Google searching at crucial moments in their financial journey. One final thing about advisors charging hourly: there is a bit of an incentive to make you keep coming back. And if you don't, the compensation they receive will be less from you than other clients and thus make you less of a priority to them. Again, it's not necessarily a problem, but something to keep in mind. Moving on to question number 4, how are you personally paid? Again, this is not the firm, it's the person, it's the lead advisor. There isn't a perfect answer here, but it may uncover an individual's incentives. A salaried employee has fewer conflicts of interest than someone who gets paid a percentage of the revenue their clients generate. I also find that a firm with salaried advisors typically give the client more access to more people. Think about it. If you're working with an advisor whose compensation is based off some percentage of the revenue they manage, will their colleagues be incentivized to help out? For example, if someone at the firm has deep experience helping with college financing and planning decisions for parents with high school-aged children, wouldn't you want input from that person if that's the needs you had? Or what if there was another advisor at the firm that isn't your primary advisor that has deep expertise in Social Security and Medicare? Or someone with deep background in exercise strategies for individuals with multiple forms of equity compensation? The list goes on and on. The point is that you want access to more than just your primary advisor. You want access to specialists. Your lead advisor is much like a primary care physician, well trained in diagnostics and perfectly capable of prescribing and treating many things. But occasionally you need a specialist. So you want your advisor and that advisor's teammates to be financially incentivized to give you that level of care when it's needed. Question 5. Do you always act as a fiduciary, and will you state that in writing? Obviously, you want a clear and simple yes to this question. If the advisor isn't willing to put it in writing, then they can't be held accountable. I would think the most obvious place for this to be included is in an advisor's client agreement. If you're unsure of where it appears, ask the advisor to point it out. And if it isn't in writing, then you might consider having them sign a fiduciary pledge, and I'll be sure to link to one in the show notes. Question 6. Do you have experience working with clients like me? You want to work with someone who has experience dealing with the issues that are relevant to you. If their response leaves you uncertain, you might consider asking what are the most common services clients like you receive. Question 7. What experience, education, and credentials do you have? I know that I've beaten this into the ground, but you do want to see someone with at least, I think, a certified financial planner designation or CFP designation. But it's nice to see someone who also maybe has a chartered financial analyst, CFA designation, or certified public accountant, CPA designation. Good additional questions that you can tie into this would be, who else will I be working with and what are their credentials? Or is there a succession plan in place? If so, how far along are you into that plan? And when do you anticipate the succession to be completed? Question 8. What is your investment philosophy? Ideally, you want someone who believes in setting long-term asset allocation and broadly diversifying using low-cost options. For firms with multiple advisors, it's also important that they all have the same investment philosophy. When advisors don't share the same investment philosophy, that typically signals that your advisor may be performing due diligence on their own. The problem when a lead advisor is responsible for due diligence, it's somewhat unreasonable to expect someone to dedicate the necessary time to fully vetting the available investment universe to make sure they have the portfolios that are best for you. It might even signal that this advisor is responsible for trading too, which is less than ideal. I mean, imagine there's a big market move when tax loss harvesting would benefit clients, but the advisor's in meetings all day and unable to trade. Now, as Chief Investment Officer, this investment philosophy question is probably good enough for the average person, but there's a lot of follow-up questions I personally would want to ask. For example, what was the last change you made to your firm's portfolios, and why was the change made? How often do you trade? How is my portfolio managed? What's your favorite investment in your own portfolio? Who manages your money? Do you believe you can beat the market? These are a few questions that if I were hiring an advisor, I'd like to know the answer for. So I've included them in the worksheet that, again, you can find in the show notes at thelongterminvestor.com. Question 9. What is the all-in cost of working with you? Costs are going to vary depending on the size of your investment account and the financial planning services you require. The bigger your account, the smaller percentage fee you should expect, but there's really no reason to pay more than 1% of assets under management. And ideally, an advisor's fee would cover all your financial planning needs as well. Question 10, what is your overall impression of the advisor? This is the final question for you to answer, and you should do so at the end of the interview before walking out of the room, and the intention is to capture your gut feeling about an advisor. Try not to overthink it, and you're going to score on a scale of 1 to 5, with 5 being the best score. The purpose of this question is to capture the intangibles the other questions lack. Did the person communicate with too much jargon? Can you envision your kids one day working with this person? Do you feel comfortable sharing every detail of your financial life with this person? If you have a significant other, you should both print all these questions individually and independently score them as the advisor's answering. And you'll want to rate each response on a scale of 1 to 5 immediately after you receive the response to your question, and do not look at each other's scores. This structured interview process that I've described here can be beneficial in a few ways. First, scoring all questions on the same scale prevents one answer from coloring your judgment about other aspects of the advisor. Second, The structured interview process prevents your brain from forming false memories by keeping an accurate measure of how you felt about an advisor's response. There's likely going to be some time lag between your different advisor interviews, and most people schedule interviews over the course of a few weeks, but it could take longer if you have a busy schedule. After you complete all your advisor interviews, add up the total scores for each advisor, and if you and your significant other scored the same advisor highest, easy, go with that advisor. If there's a discrepancy, talk it out or find a way to reach a clear consensus. For example, you could ask your favorite 2 advisors to draft a sample financial plan for you to review and compare. They'll require you to share some personal information such as investment statements and tax returns, but this ought to help you identify the person who will help you best meet your needs. And this probably sounds like a lot of work, but it is a huge decision. As I've expressed a few times in this series, hiring a financial advisor can be the best decision you ever make, so long as you hire a good advisor. Following the process laid out here, I think increases your chances of avoiding a bad advisor. Make sure to work through this process with your significant other, even if one person handles most of the household finances. And alternatively, if you're single, you might consider bringing along a trusted friend or family member to provide a second set of scores. Now, so far I've only been focused on hiring human advisors, but I think it would be a mistake to totally ignore the robo-advisor universe. Robo-advisor is an industry term for a digital platform that automates your investments for a percentage fee based on your assets under management. This growing segment serves a huge number of investors who were previously forced to either do it themselves, which opens a lot of people up for a plethora of mistakes, or work with brokers who weren't required to act as fiduciaries. There's also hybrid advisors who go beyond automated investment platforms, and they also provide a little bit of financial planning through a digital platform you can use to track your process, make adjustments, and manage various goals. On top of the digital experience, these hybrid advisors also provide you with access to a financial planner, many of whom are CFP professionals, to further hone and personalize your financial plan. Using a robo or a hybrid advisor is probably the most cost-effective way for people to manage their money if they have less than $500,000 in investable assets. Now, nearly all digital advisors believe in the tenets of long-term asset allocation, diversification, low costs, dollar cost averaging, rebalancing, tax-efficient portfolio strategies, etc. If you also need a little financial planning, hybrid advisors provide financial planning advice at a fraction of the cost of a human financial planner. However, it's just not going to be as comprehensive or as proactive, and chances are you won't have access to as great a depth of experience as you would working with a human. In my opinion, there are 2 things to look for in a digital advisor. The first is being able to meet with a certified financial planner at no additional cost, because life is more complicated than any algorithm could create. And second, I would say that you would want a digital advisor that always acts as a fiduciary. Several digital advisors are registered investment advisors, RIAs, which means that by law, they must always act in your best interest. But you can also look for the certified fiduciary designation for the Center of Fiduciary Excellence. And I'll put a link in the show notes again where you can see all CFIC certified firms, robo or human. All the information in this episode can be found in the show notes at thelongterminvestor.com, as well as by downloading the How to Interview an Advisor worksheet. And if you'd like to learn more about working with me, you can also do so by visiting thelongterminvestor.com. And while you're there, go ahead and submit a question for me to answer on a future episode. As always, thanks for listening, and until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.